Good morning. This is Chris Kohlberg for the post-award ReConnect accounting program, and I will be doing the presentation today. I just want to introduce myself first and foremost. My name is Chris Kohlberg. I have a hat on today to give a little bit of ribbing to my friend in North Dakota because we're going to, since all the spring sports are now eliminated, we're going to start a esports team, and I'm sure the Grizz will beat the North Dakota State Bisons in esports. Anyway, as I said, my name is Chris Kohlberg. I'm a branch chief for the Northern Region Accounting Branch, and I have about 20 years experience in rural utility service and about 30 years experience in public accounting, finance, and governmental accounting. Today, our agenda will be the following. So I am going to go over the accounting principles, the Code of Federal Regulations, 7 CFR 1773, the policy on audits, internal controls, and compliance with construction procedures, capitalization versus financing, and documentation requirements if time permits. I do foresee that I won't get through all of my slides today, but I'm hoping that we will. Oh, by the way, I'm going to take off my hat now, and since Corey managed to respond to me, if the glare is too much, please just realize I am bald. So anyway, let's get started. Accounting principles. So your financial statements and everything you do related to the accounting for forecasting and for preparing your financial statements and accounting for your construction costs should be done in conformity with generally accepted accounting principles. Those accounting principles are basically, hold on a second, we had an issue that we have no video. Hold on one second. Do we have video? Do you guys have video of me? Hello? Okay. So hold tight one second. I'm just having the IT Corner Alliance people check. I just got a thing that someone said they do not have video of me.
Yes, we've got video. I'll go ahead and respond.
Okay. Okay.
Go on.
Apparently, I do have video, so I'm going to keep going. The other thing that we have to keep in mind is that the general accepted accounting principles are either designated by FASB, Financial Accounting Standards Board, or by GASB, the Governmental Accounting Standards Board, depending on the type of entity that you are. And you should be working closely with your accountant and controller, as well as your auditor, to make sure you're in compliance with that. The other item that we consider accounting principles is the telephone uniform system of accounts, and as well as the electric uniform system of accounts. And we'll get into that in more detail, but all of the chart of accounts for all ReConnect awardees must be in compliance with the telephone uniform system of accounts. And you should make all efforts possible to comply with that particular system. And for the electric program, the electric cooperatives and electric companies in general, although yours is in compliance with the electric uniform system of accounts, you should make sure that you're in compliance, at least from the broadband subsidiary portion, with the telephone uniform system of accounts. Also, the other item that we consider generally accepted accounting principles that you have to comply with are the Code of Federal Regulations, Title II, Grants and Agreements, and specifically the cost principles outlined there, and we will get into those in more detail. Basically, as I mentioned just in the previous slide, the entity determines the overall accounting principles. For-profit private entities, you will be following Financial Accounting Standards Board accounting principles, and you will make sure that if you have a particular departure from the telephone USOA, that you get those approved in advance. Cooperatives are not considered a not-for-profit. They're actually considered a rate-based entity, and so they are specifically excluded under FASB from the not-for-profit entities. So you will be following basically the ASC 980 for related regulatory assets, and then following the telephone USOA, as well as for electric cooperatives, the electric cooperative USOA. Not-for-profit entities that are truly not-for-profit entities and not governmental entities do follow FASB, and I'm giving you the old standards there. It was FASB 117 and 118 that basically outlined how a not-for-profit records its assets, liabilities, and records revenue and grants and contributions. So you will be following those. Again, you will have to make sure that if you have a departure from the telephone USOA, that you are approved in advance. Finally, governmental entities follow governmental accounting standards board, and the departures from the telephone USOA must be approved in advance. Keep in mind that for most government entities, your particular broadband project will most likely be under an enterprise fund, and you should follow full accrual accounting under that. However, in some instances, you may find that you are not a full accrual entity, and then therefore it's not an enterprise fund. But you should follow the GASB standards for determining an enterprise fund and go from there. Some of the general accounting principles that are not allowed, and this is in particularly important for LLCs. Keep in mind, many LLCs are basically a partnership and tend to do tax basis accounting. For our entities, that is not allowed. You have to be full accrual accounting and follow FASB standards, just like you were a corporation or another entity. Cash basis is also not allowed. So if you're a small privately held organization, you cannot do cash basis accounting. You have to be full GAAP accounting and full accrual accounting. Some of the items that are common elements for generally accepted accounting principles. Mainly under most generally accepted accounting principles, there are certain ideas or concepts that are universal. The first is conservatism, the second, comparability, the third, consistency, and then also matching principles. There are other ones, but I just wanted to highlight those because in particular, when you're doing your ReConnect award program, the accounting needs to follow these items very closely. All of our standards and requirements are related to this particular, these set of principles. And the Code of Federal Regulations .200 even puts it at a even more restrictive level, so keep that in mind. Also, in general, everyone should look at FASB Accounting Standards Codified ASC 360, which is self-constructed assets. Basically, it outlines three particular areas that you should follow. First, all direct costs are included in the total cost of the asset. Keep in mind, even though they may be direct costs, they may not be eligible for financing. Fixed overhead costs are not included unless they are increased by the construction of the asset. We do allow, under the Telephone Uniform System of Accounts and under the operating manuals, for overhead costs related to direct costs. Keep in mind, though, that in some instances we do have limitations, but you need to follow the Uniform System of Accounts and the telephone operating manual to make sure that you're in compliance with those overhead costs. Finally, interest costs may or may not be capitalized. In general, the Telephone Uniform System of Accounts requires capitalization of interest. However, interest will be capitalized, but it may not be financed. And let me just, we'll go over that in more detail, but I just wanted to say AFUDC is not eligible for financing, and IDC, or interest during construction that is actually incurred but not imputed, can be financed, but it has to be approved in advance, and you would have to get written approval before you even enter into the obligation and ask for that to be an acceptable item for financing. Common elements of all GAAP. As we go through .200, the common elements for all GAAP are reasonable, allocable, and eligible, as well as necessary, as I outlined on the previous slide. and costs for internally generated assets must have a direct relation to construction. What I say in the parentheses there, note, indirect costs are really direct costs that cannot be specifically identified to a specific project. Basically, overhead costs related to labor, material, and overhead are allowed, but they're really essentially a direct cost that was incurred because of the construction of that asset, but we couldn't identify it specifically to the asset, so we allocate it based on procedures, which I will go through a little bit in the end of the slides. Okay, so let's go to the Telephone Uniform System of Accounts, 1770B-1, Part 32. This is basically the chart of accounts that will be going to electric and non-telephone borrowers must have a general ledger chart of accounts that complies with the system for purposes of projects funded by ReConnect loans and grants. As I put there in parentheses, you may want to consider using a division within your chart of accounts for reporting so that it is in compliance. However, you don't have to do that, but you have to make sure that if there's a particular way an account is classified in the balance sheet, or an overhead is amortized or cleared to a particular account, that it has to be done in a manner that is similar to the uniform system of accounts. Part 32 also goes over the records of the company, and that's something at the end of the program that I want to discuss, but I may not have time, so I make sure I highlight it here. It is important for you to know that the company's financial records shall be kept in accordance with generally accepted accounting principles to the extent permitted by this system. Also, the company's financial records shall be kept with sufficient particularity, detailed evidence, to show fully the facts pertaining to all entries in these accounts. The detailed records shall be filed in such a manner as to be readily available for examination. So that is something to keep in mind as we move forward through this whole process, is that you need to document particular transactions to a level of detail that can show us from beginning to end what form of funding was used, how the cost actually was calculated, and based on evidence such as original source documentation. And they have to be readily available for examination and kept as a retention policy until at least 3 years until after audited. But in many cases, that is just for the retention period to begin. And as you go forward, the retention period may be the life of the assets, or it may be even longer than the life of the assets. So keep that in mind as we move forward. Did I go? Hold on a second, let me. So the commission, and this was originally from the FCC, but RUS shall require a company to maintain financial and other subsidiary records in such a manner that specific information of a type not warranting disclosure as an account or sub-account will be readily available. I'm highlighting a couple of things here in red for you. Subsidiary loan budget records. This is something that's very important, and when you go through the construction procedures, to keep in mind that there are basically 4 items that you are keeping track of during a construction of a particular part of a project. Number 1, you have the amount that the actual contractor has constructed. The operations program should be maintaining, tracking, and looking at that they are on time and in accordance with the overall construction timelines of the contract. But then you also have what they've actually billed you. Those 2 things may not match. In addition to that, what you have been billed by the contractor may not be what you've paid, and what you have paid to the contractor may not be what's approved for advance or advanced and reimbursed by RUS. All 4 of these items need to be in a subsidiary loan budget record, making sure that you can track this at any one particular time so that we know at the end of the actual contract itself and at the end of the project itself that we have sufficient costs that equal the contract closeouts for what was actually built, and is in accordance with what was approved, advanced, and dispersed from the pledge deposit account. In addition, you should have a pledge deposit account reimbursement schedule. This basically shows every time an advance comes down and is deposited, and then when you take it out of the pledge deposit account, the budget purpose or budget purposes that you're taking them out for in relation to the financial requirement statement. This is important to understand that this is the basic starting point of all of the audits that we conduct. If this is not available, then we already run into a situation where we do not have sufficient evidence to know what projects you've reimbursed yourself for. So if there is a difference in a particular contract, we would end up having a disallowance or insufficient evidence to know that you have reimbursed yourself for that particular project. So it's very important to keep in mind. Continuing property records, which is basically a subsidiary asset listing. This has to be detailed, and I go into it in more detail later on, but let me just say it can't be detailed enough. You need to know what kind of funds were used, whether they were matching funds, grant funds, or loan funds, as well as serial numbers, items such as that nature, and geolocations, so that if a GFR or a field accountant has to physically inspect that particular piece of equipment, that we can go find it and verify it to original source documentation. Finally, labor, material, and overhead subsidiary ledgers, as well as source documentation such as charge-out sheets, labor distribution reports, timesheets, and other things need to provide us specific information that can be identified and rolled up into a project. So we have to go from the initial point of the labor cost all the way to the constructed asset and be able to know that that can be traced back to source documentation. I know that's a lot of information, but as we go through the process, you will be provided more information, and we'll, be able to work with you. And it does work smoothly when we set them up correctly at the beginning. In general, the Uniform System of Accounts also covers things where the use of subsidiary records is considered necessary. And as I talked about, you need to be able to reconcile the general ledger books to original entry as appropriate, shall adequately document the accounting procedures related to subsidiary records, and it shall be maintained at an adequate level of detail to satisfy regulators. Continuing on, as I talked about, the subsidiary fixed asset listing is what we call the continuing property records, reconciles to the actual total dollar amount within the classified plan accounts. This has to be detailed, and as I've covered this, I provided a list of items here that you have to consider in your documentation, but this is just a portion of them. You may find that there's other information that needs to be provided in order to adequately document something that is combined into a larger asset. Also, plan accounts should be divided into the classified plan accounts based on the Uniform System of Accounts and standard retirement units, so that we can tie these back to the general ledger. Okay, moving on to DOT 200. DOT 200 is the cost principles that cover both the cost principles for grants and agreements, including loans, as well as for non-federal entities that fall under not-for-profit governmental units and territories or sovereign nations within the United States of America that have to follow the audit regulations. But here today, what I'm going to just cover is the composition of costs. Composition of costs. DOT 402 basically discusses that total cost of the federal award is a sum of allowable direct and allocable indirect costs less any applicable credits. And let me just stop here and say applicable credits would be anything such as your match or any contribution in aid of construction that would reduce the amount of the actual cost of the construction, and that is what would be considered the total cost of the federal award. The next item is very important. Factors affecting allowability of costs. Except where otherwise authorized by statutes, costs must meet the following criteria to be allowable under federal awards. Necessary and reasonable, conform to limitations or exclusions set forth in these principles or in the federal award as to types of amount or cost items. And so that's important when you're going through your loan grant agreement and the construction procedures, that you make sure you go through there and determine any costs that should not be allowed. Be consistent with policies and procedures that apply uniformly to both federally financed and other activities of the non-federal entity. And for here, this applies to even those particular entities that are not under that are not considered a non-federal entity under DOT 200. All ReConnect awardees have to make sure their policies and procedures are consistent between federally financed and non-federally financed activities. And let me just give a small example of what that would mean. So if you basically pay an installer to go out and do customer premise equipment, and that your installer is making $15 an hour on all non-federally funded construction, then when they our project, they can't be making a different dollar amount. They have to be paid the same dollar amount. And those dollar amounts have to be reasonable for that particular area, which I will get into next. The other items in 403 that we should cover are a consistent treatment. A cost may not be assigned to a federal award as a direct cost if any other cost incurred for the same purpose in like circumstances has been allocated as an indirect cost. So that's basically, you have to treat it one way. It has to be determined with generally accepted accounting principles, except for state and local governments and Indian tribes only, as otherwise provided for in this part. Yes, and I'll define this right now for people. I see I have a question here. Non-federal entities are state, local governments, Indian tribes, and not-for-profit organizations, excluding cooperatives. However, for purposes of our loan grant agreement, we are applying all cost principles to all federal awardees. So they have to comply with DOT 200 cost principles, but only non-federal entities will be complying with the audit portion. In the entities that are not deemed non-federal, so electric cooperatives, for-profit entities, telephone cooperatives, those kind of entities, will comply with 1773, which I will get to in just a moment. And as you can see here at the final bullet, DOT 200 also it describes that it must be adequately documented. So you can reference it and you'll see that we basically say it has to be adequately documented several times throughout all our regulations. So pay particularly close attention as you're incurring these costs that you have adequately set up documentation procedures. One of the biggest questions we get is, what is a reasonable cost? And so let me just read this to you and let it sink in as you go forward. A cost is reasonable if, in its nature and amount, it does not exceed that which would be incurred by a prudent person. And I always, in the pre-award conferences, said the prudent person you should consider is a government auditor, not just what you think a prudent person is, but a government auditor tasked with making sure taxpayer money is not subject to fraud, waste, and abuse. Under the circumstances prevailing at the time the decision was made to incur the cost. So that is important. It's contemporaneous. You need to make sure that it is prudent at the time you incurred the cost. The question of reasonableness is particularly important when the non-federal entity is predominantly federal funded. In many instances, we are going to be going through these programs where a large percentage of you are doing this project, which is completely federally funded, or in a large is predominantly federally funded. So as I put here in red, i.e., as we talked about, is internally constructed assets, must have a direct relationship and must be necessary for construction at a reasonable rate. Reasonable costs. Whether the cost of a type generally recognized as ordinary and necessary for the operation of the non-federal entity or the proper and efficient performance of the federal award. So I put in some just kind of outrageous examples here, but it just kind of prompting you to think about what is reasonable. An administrative assistance labor cost is not necessary for construction. Answering the phones, doing things like that nature, they do not have a direct relationship to construction. And as an overhead are not allocable to construction because they have no relation to the direct costs. In addition, B, the restraints or requirements imposed by such factors as sound business practices. One of the things that I always say through my kind of descriptions is, in some cases, your general manager may actually be out there running a trencher. However, your general manager's salary is not reasonable. Also, anyone under the 60 that would code their time to 6711, you need to make sure that you have that their time is actually not eligible for financing. So if you are going to have a situation where your general manager is going to actually be physically involved in the physical construction of an asset, you need to get a departure from the Uniform System of Accounts approved in advance. Again, one of the items I put in here in red, affiliated transactions must be pre-approved and at cost with no profit margin, and must provide evidence of true costs from affiliates' records, which means we will also maybe it is required, but we may as auditors come in and look at the affiliated records to make sure the cost is a true cost and does not have a profit margin in it. I just talked about this, market prices for comparable goods or services for the geographic areas. Again, we need to make sure that we're charging at the actual rate a person would make for that. Not increasing salaries for work performed under a ReConnect is not reasonable. Whether the individuals concerned acted with prudence in the circumstances, considering their responsibilities to the non-federal entity, its employees, where applicable, its students or membership, the public at large, and the federal government. So as a taxpayer, ask yourself this each time you incur a cost. As a taxpayer, would you be okay with what you are trying to finance? And then be extra conservative and think, as an auditor or a prudent person, would they do it? So buying state-of-the-art construction equipment when renting would have resulted in savings to taxpayer, that is not reasonable. So keep in mind, these are just some outrageous examples, but there are more examples than these that I put forward that would be applicable, and you should consider this as you incur costs. Continuing on with reasonable costs. E, non-federal entity significantly deviates from its established practices and procedures. Again, changing your policy, you have to be consistent. You cannot increase an amount charged to a federal award just because you've changed your overtime policy or something like that. You must employ conservatism, prudent person, third party, arm's length, and geographic market considerations in all transactions. When in doubt, do not capitalize and do not finance. If you doubt it, the federal government will probably doubt it as well. Allocable costs, 405. A cost is allocable to a particular federal award or other cost objective if the goods or services involved are chargeable or assignable to that federal award or cost objective in accordance with relative benefits received. As I said earlier in the slide, consider ASC 360 self-constructed assets as a basis for every starting point for whether or not it is allocable to a federal award. 1, it is incurred specifically for federal award. 2, it benefits both the federal award and other work of the federal non-federal entity and can be distributed in proportions that may be approximated using reasonable methods. Our reasonable methods are approved allocation methods under Bulletin 1770-1, work order procedures for the telephone system to allocate these costs. I've included some of these in this presentation, but that bulletin is also available at request. I don't believe it's online right now, but we will make it available online. Eligible. Even if a cost is reasonable and allocable, it still may not be eligible. Particularly, allowance for funds used during construction should be capitalized if the criteria for AFUDC is met under the Telephone Uniform System of Accounts, but this cannot be financed. We do not finance an imputed cost that is related to an interest that was basically an interest imputed based on our interest that would be payable to us. Internal control systems must accumulate the cost of AFUDC, but it must be reduced on the summary of work orders, which is the 770 or 770A, 771, excuse me, before the cost is submitted for financing. The GFR can help you with how to account for that when you submit items through the work order system for financing. In addition, I highlight as I noted before, executive compensation, account 6711. Any costs that would normally be included under account 6711 are not eligible for financing, even if the amount is reasonable and allocable. So, to deviate from this, if you actually have a general manager or some other executive that would have put this under the uniform system of accounts, they would have to ask for this approval in advance, and we may or may not approve it. So keep in mind that is a departure from the uniform system of accounts, and that those type of compensations cannot be financed. Also, considerations for selected items of costs. For the most part, the telephone uniform system of accounts, work order procedures, and our ReConnect construction procedures outline the costs of construction that meet the eligibility criteria, as well as outlining some of the items that are not eligible for financing. But it is important that you also go through the .200s, 420, and make sure that you don't have any costs that fall into these particularly excluded items. For example, all federal grants and agreements cannot finance alcoholic beverages. So if you are actually charging actual costs for a person who is on a remote site doing construction, and you are allocating costs for the actual cost of food, and they charge a alcoholic beverage on that item, it would not be allowable. So you would have to reduce that before you put it through your internal control system. Keep in mind that that's one of the reasons why most people use a per diem rate or something of that nature. And those are only financeable if it is required and necessary that that person was out on site for that particular construction period and not able to return home. I know that was a lot. We're going to probably run out of time, but I wanted to emphasize those items because it's very important that you keep that in mind as you move forward, that the cost procedures are a very important aspect of doing business with the federal government. As I noted before, non-federal entities are subject, and again, non-federal entities being state, local governments, Indian tribes, sovereign nations, territories, and if I didn't say it already, not-for-profit organizations, they're subject to the audit rules of .200. Everyone is subject to the cost principles of the .200s under Section 400. For those entities that are not subject to the audit rules of .200, you are subject to the Code of Federal Regulations 7 CFR 1773 policy on audits. And I'm going to go through that as quickly as I can, but we're probably going to run out of time here. Effective after an advance has been made, 120 days from the end of an advancee's current fiscal year, and thereafter 120 days from the close of each subsequent fiscal year, the awardee must submit annual audited financial statements along with a report on compliance on internal control over financial reporting and what we call a management letter, but it is actually called the contractual obligations, agreed upon procedures for contractual obligations, in accordance with the requirements of 7 CFR 1773. And we have exhibits under the bulletin for 1773 does have exhibits, and we can provide that for your review if you have questions. Again, note, non-federal entities under 200, which have 9 months to submit an audit. This date is actually a little bit shorter, and you should keep in mind that while you have 9 months as non-federal entities to submit under .200, you should submit it within 30 days of your audit being completed by the auditor. So there are 2 dates that you need to keep in mind. If you're a 1773 borrower, it's 120 days. If you're a non-federal entity under .200, it's 9 months, or the shorter of if you get your audit done within 30 days of your receipt from your auditor. Okay, I was able to move. Each auditee must have its financial statements audited annually by an auditor selected by the auditee and approved by RUS as set forth in 1773.4. Keep in mind, we do not require specific approval, written approval. We assume that approval has been made because you would have checked to make sure that the peer review has been updated and the auditor has the specific skills and requirements to complete the audit. However, if we go through and have questions on a particular auditor and we find that the auditor is not in compliance with their peer review, that we will have deemed not to have approved it. You have to establish an annual audit date within 12 months of the date of the first advance, and you must prepare annual financial statements for the audit date established. Keep in mind, these have to be comparable audited financial statements. Each auditee must notify AA-PARA of the audit date at least 90 days prior to the selected audit date. We are going to be trying to get that audit date ahead of time, but keep in mind, you are required to let us know what your audit date is. In addition to this requirements of this part, certain oddities, as I noted before, may be subject to the Single Audit Act, which is subpart F, .200 of the Title II CFR grants and agreements. You have specific responsibilities that you must do under 1773. You have to select a qualified auditor. The auditee's governance board is responsible for the selection of a qualified auditor that meets the requirements set forth in 1773.5. The qualifications of the auditors are available to do the work, their experience in performing audits of utilities, related industries, or in cases of the grantees, experience in auditing entities comparable to the grantee, and they have to be able to complete the audit and submit the audit reporting package within 120 days of the audit. This says 90, but within 120 days. They have to do it within 90, so you can submit it within 120 days. Keep in mind, there may be exigent circumstances that they cannot do it, but you have to, in selection of your auditor, you need to make sure that that auditor is capable of completing the work in a timely fashion. The board's approval of an auditor must be recorded by a resolution that states the auditor represents that it meets the RUS qualifications to perform an audit, and the auditee and auditor will enter into an engagement letter in accordance with 1773.6. We don't need a copy of the engagement letter at this point in time, but you do need to have a copy of the engagement letter available for inspection if we have a question. Auditee's responsibilities continue. You need to notify us of the selection of the auditor or subsequent change of the auditor within at least 90 days prior to the audit date. This is so that we can get the auditor submitted into the SARS system and available, so we know we can accept audits from you when the audit comes in. You must enter into an engagement letter, as I said, and it has to comply with 1773.6. You have to have you must obtain from the selected auditor a lower tiered covered transaction certification, Form AD 1048, and you have to obtain from the selected auditor a copy of the current approved peer review report. Qualifications of the auditor. Auditors that meet the qualifications criteria in this section and entered into an audit engagement complies will be considered satisfactory to RUS. They have to be licensed to audit in the United States of America, independent, and they have to have a peer review. The peer review requirements, they all have to be enrolled and participating in a peer review and must have undergone a satisfactory peer review of their accounting and auditing practice. The peer review must be in effect at the date of the audit report opinion. We do reserve the right to request peer review reports, but we do not require you to send the peer review in at this time. You must obtain from the selected auditor a copy of the auditor's current approved peer review report and have it available for examination if requested. Access to audit documentation. Pursuant to the terms of this part, an audit engagement letter and the audit engagement letter, the auditor must make all audit documentation available to RUS or its designated representative upon request and must permit RUS or its designated representative to photocopy all audit documentation. So just like the affiliates, keep in mind that these people your auditor is entering into a transaction for which they have to make available their audit work papers so that we can look at their audit documentation if we have a question that is related to the tests that they have performed. Continuing on, the auditor's review and submission of the reporting package. The governance board should note and record receipt of the reporting package and take action in response to the reporting package in the minutes of the board meeting. One of the things that this basically indicates is that your board should go over with the auditor the actual results of the audit and any questions or findings or question costs or any other items that have been discovered during the course of that audit. And they should record in the minutes that they have met with the auditor and are accepting the audit report package as presented. The auditee must furnish an electronic copy of the reporting package within 120 days of the audit date as provided for in 1773.3. And keep in mind that will probably be in the the broadband intake system or the financial and compliance reporting part of that intake system and not what we call DCS, but you will be provided instructions with that at a later date. If there is items that require a plan for corrective action, you must provide us a copy of your corrective action plan within 180 days of the audit date. You must also include in the reporting package a copy of each special report, summary of recommendations, or similar communications if received from the auditors as a result of the audit. All required submissions to RUS described in the paragraphs above should be furnished electronically, must be provided in a portable document format or PDF format, and uploaded into the appropriate system. Okay, final slide on this. Sorry to keep harping on this, and I know we're running out of time. RUS reporting requirements. Keep in mind, audits report on the financial statements. They have to have an opinion on the financial statements. They have to provide the report on internal control and financial reporting and compliance on other financial matters. They also have to provide under 1773 a report on compliance with aspects of contractual agreements and regulatory requirements. And the contractual agreements and regulatory requirements are outlined under 1773 and specifically what they have to opine on. And we do provide a copy of a template that outlines each bullet point that the auditor must cover under this report. And if applicable, the schedule of findings and recommendations. Going on to internal controls. We have about 6 minutes left and I will just go through this briefly. I have provided you the electronic copy of the work order procedures for telephone borrowers. This is the basic internal controls over construction under a work order system, and it's not to be construed or confused with the construction procedures. The construction procedures are the things that you have to follow related to the telephone system, and those are provided on the ReConnect website. But these are the internal controls that get you in compliance with the uniform system of accounts in capitalizing each element of costs related to labor, material, and overheads. Contributions in the form of money or its equivalent toward the construction of telephone communication plants are credited to the accounts charged with such construction. Contribution in aids of construction should be reduced on the summary of work orders. So I know we had a question, and I'm going to just kind of address that now, and we'll circle back to it. Yes, the contribution in aid of construction actually credits the construction work in progress at the time that it is received. But when you are putting your work orders together, on the summary of work orders, you put the gross amount of labor, material, and overhead and other costs, and then show it as a reduction for the contribution and aided construction to come up to the net amount that is recorded in your construction work in progress and then transferred out as a individual work order to the classified plan accounts. I know that's a little bit confusing, but if we can go over it a little bit more in detail when we start the Q&A in about 4 minutes. Estimated work orders. Estimated work orders should be prepared as necessary to meet management needs. This is an important cost control element. You should, before going out to do a particular internal work order using internal labor, material, and overhead, do a estimate of what those costs are going to be so that you can maintain cost control as the work is progressed. You cannot finance an estimated work order. You have to actually, it's just done to control costs, and you will finance the work order once the construction is complete and the particular assets are ready to be placed into service. A construction work order should accumulate in one record all costs assignable to a specific edition of telecommunications plan, or as we would say here, broadband plan. It is important to note that all costs related to an addition should be included in that construction work order, but as we noted before, things that are not eligible for financing must be reduced prior to submission to RUS. Work order procedure. ReConnect work orders will also have to be segregated further to comply with construction procedures and differentiate between PFSA and non-funded service areas. It's important to note that you will probably have to do a little bit of additional work to make sure that you have all of the costs segregated by those particular type of areas so that when you submit it for financing, we are only financing things in the funded area. I'm going to run out of time, so I just wanted to go back down. I go through all of the costs related to labor, material, and overhead in this particular slides, but you can find on the website, and this presentation will be available to all awardees, and the External Compliance Division will be able to answer your questions through the help desk or through other means if necessary on how to obtain the information. I just wanted to go down real quickly because I have run out of time to discuss the construction procedures. Keep in mind, you have specific construction procedures for the ReConnect program that the telecommunications program has said you must comply with. This has to be complied with along with the USOA and work order procedures outlined above. In a case where you think there is a perceived conflict that exists between these documents or in the internal control system of awardee, you should communicate this to the RUS ReConnect staff and vet it through the program staff, and we will work in the External Compliance Division will work with the RUS program staff to make sure that the procedure is implemented that complies with the construction procedures you have to comply with for the ReConnect program. I'm sorry that I was not able to get through my entire presentation. So the other item that I do have to cover is documentation. And I talked about it briefly, but we must know that all documentation must be contemporary. Okay, hold on. You guys see me? Okay. Sorry.
Yep.
I apparently lost connection. I don't know why. Not sure if it was on my end or what, but we now need to go answer questions. So I hope people are still available and can still hear me. At this time, my company does cash-based accounting. Do I have to switch my entire company to accrual-based accounting, or only do accrual-based accounting for this grant project? The simple answer is your audited financial statements are based on the entity, and the entity has to be in compliance with generally accepted accounting principles. So your company has to be on full accrual accounting. Your audit cannot just be for the grant project itself. I'm going to say I answered that. So Patrick, so one of the GFRs asked what if an expense is disallowed. So if you submit a cost for financing, it goes through the system, and then our field accountants go out and do an audit and determines that a cost should be disallowed. At that point in time, we issue a disallowance, and you have to put the money back. The cash can be allocated to another cost incurred, or if the project is done and you have no eligible cost to be offset, then you actually have to repay the cost back to the Treasury Department. And you would work through RUS and the Rural Development External Compliance Division in St. Louis to handle such a situation. And so it's important to note, that's why I try to emphasize costs are so important, that you are following the cost principles and you are using conservatism and following the rules, because it is a situation no one wants to go through, that you have a disallowance at that time. So I have a question here from TEC. Under the telephone system of accounts, any plant constructed outside the certificated area is treated as non-regulated, so it's not charged to the normal cable and equipment accounts. I believe that some of our ReConnect projects are at least partially outside. Just wanted to clarify. This is a good question. Especially because if you're a regulated entity and you're getting rate regulation, rate payments, then you probably do have to conform with this. But I would like to get back to this answer. And so Joan and the Corner Alliance people, if you could actually say that we didn't answer this, but we'll get back to it, I definitely want to make sure I get that complete question to him. If an affiliated entity or the entity acquired new equipment for the purpose of construction, could the entity accrue charges for the use of equipment commensurate of lease costs for the equipment? So it is important to note, on an affiliated entity, if you are using affiliated entity equipment, it has to be based on cost. So the cost must be commensurate with actual cost details. So in this question, it may be able to do it on the lease cost basis, but it's on the cost basis, not on a profit basis. And we have to be able to determine what that cost is. It should be allocated based on the equipment charges or transportation charges under the Uniform System of Accounts, and only the hours used or miles driven should be applied based on that cost. And it should be done under that manner. So if you would like to do an actual lease for the cost of affiliated equipment, you need to get that approved in advance from the telecommunications program. Let's see. To be a cost does not seem to comply, part 32. So this particular item, we are all of our loan grant agreements require that affiliated transactions come through at cost. We do not allow this item, even though this particular item says parts 32 and part 64 allows for non-affiliated customers. If you have a affiliated company that can prove that it has other non-affiliated companies, then you can submit this as a departure and allow for third party to be considered. But from the standpoint of our standpoint, we are going to say that everything must come through at cost, unless you can prove otherwise. And then at this level here, on this particular question, you would have to basically open up the affiliated company's revenue books, and so we could see what the true, if it really is just a minor piece of that business, and how much of it is an affiliated. If it's 100% affiliated, the answer would probably still be no. So keep that in mind, that you need to go through specific procedures to get a departure from here. We understand that in some cases, some entities do, through Part 32, allow for a cost to be not just at cost, but also include a revenue. But for purposes of ReConnect and all our loan grant agreements, we say they have to be at cost. So if you would like this cost to come through with a profit margin, you're going to have to prove that it is under these circumstances allowable, and you're going to have to get permission from the telecommunications program, and that particular approval may not happen. Just keep that in mind. Would a for-profit entity for grant funds account for grant funds in this way? Grant funds for for-profit entities, we go over and we provide guidance. We're in the process of trying to get that posted on the website. For-profit entities go through a deferred revenue. They do not follow the contribution and aid to construction unless you are a for-profit regulated telephone system. You cannot, under FASB, account for for-profit entities. They cannot account for grant funds in this way. We do provide that guidance online, and it will be available at some point in time in the future. Okay, so just real quickly, AA-PARA does no longer exist. It is actually the director for the External Compliance Division, and her name is Ann Bradley. I was quoting from the regulation, which has the old language. We've since done a realignment, but that was originally the Assistant Administrator for Program Accounting and Regulatory Analysis. That title is now the Director for the External Compliance Division, and that person's name is Ann Bradley, and she's my direct supervisor. We will provide information on how to get the notification, but we have a actual email address that you. Okay. Sorry, guys. I obviously experiencing some difficulty at the end of this streaming. So we are long-term RUS borrower and now a ReConnect awardee. Will our current auditors continue to be acceptable? Yes. They, again, we require you to get approval from us, but we deem to have approval of all RUS auditors unless we find out information to the contrary. So if you already have an existing auditor, they are basically approved. If you're new to the program and we don't have a record of your current borrower or your current auditor, you need to provide us with that information, and we will post the notification process on either the ReConnect website or a site to be determined, and we'll try and get that information disseminated out to you as quickly as possible. Our auditors say that GAAP will not allow us to credit the plant account with grant proceeds, but they have to be recorded as a deferred liability that is to be amortized over the revenue of the life of the plant. Our auditors, if you are a telephone or electric cooperative or regulated entity, to use the contribution and aid of construction method. However, as your auditors noted, that may not be in compliance with GAAP, and therefore you have to do it in a different fashion. That is fine. You actually, everyone has the option of using the deferred revenue method. It's just that the only ones that have the option of doing it as contribution in aid of construction are the regulated entities, because it's allowed for under Part 32. Where Part 32 deviates from GAAP, we know that there are instances where they deviate from GAAP, that GAAP we have to reconcile to that particular item, and we will, on a case-by-case basis, make sure that we comply with that. So we would rely on your auditors to do that. And okay, so I'm basically got 2 more minutes. Do you have guidance to determine how costs that are separated by geocode when you have fiber going through the funded areas to get to funded areas? That is a great question, and I would say this. You're going to have to check with your GFR. Fiber would be a unique system and a unique issue related to geolocation. Mainly when we talk about geolocation, it's things that we can actually go geolocate. We're not going to certainly dig out fiber strands from the ground to actually go inspect those. So I would work with your GFR and find out how you do that. So we are a new borrower and a ReConnect awardee. Will we have to report in both DCS and whatever the new reporting system is? It is my understanding right now that the new broadband intake system will allocate to the DCS system or allow us to capture it for other reporting systems. So I don't think the answer at this time is yes. In fact, but I would hesitate to say that we got to make sure that the intake system is working correctly and updating those other systems. But at this point in time, it is my understanding that the DCS system would not have to be reported in separately, because the new reporting system will allow for connection to DCS, or we will handle it somehow. But if I'm wrong on that, we will provide additional guidance later on. Will separate work orders be necessary for areas inside the PFSA and NFSA? Our area is complicated, is that there's some homes passed in the grant, then some out of the grant. This is one of the things that is going to be a very difficult thing. If you do a blanket work order, or you do a work order that combines PFSA and NFSA, you have to determine how you're going to separate those costs out. That's what I was talking about on the summary of work orders. If you combine, because they're out working jointly in one, our preferred method would be that there be separate work orders. If it is not allowed, or it cannot be done in a where it's too much of a burden, then you would have to find out and make sure that the way you are allocating that cost is reasonable and it can be traced back to actual costs. So if you're doing an allocation from this particular issue, you need to work closely with your GFR and your field accountant to make sure that it is covered and that it is acceptable to RUS. Yes, non-federal entities use full accrual accounting unless you are a small municipality, as I said, and you do not account for it in an enterprise fund. If you don't do it in an enterprise fund, then GASB allows you to do it as non-accrual accounting. But you need to make sure, as a small municipality, that you are actually not meeting the requirements of an enterprise fund for the project itself. For the entity itself, because GASB allows for non-full accrual, your entity would be in accordance with GASB if you still had certain funds that are not accounted for. They're accounted for as a government fund, or a special revenue fund, or some other non-full accrual accounting. We just keep in mind, though, you may have to do full accrual accounting on your broadband project if it's deemed under GASB to be accounted for in an enterprise fund, which most likely it would be based on my knowledge of the GASB tests that you have to go through. If you want additional questions, you can reach out to me. Tara Heyer, Corner Alliance can provide more detail, but we can go over that later on. Would you recommend an awardee use an RUS bidding process and construction contract to ensure compliance? The construction procedures specifically go over this, and yes, you should use the bidding process. Off the top of my head, I don't know where the construction procedures come out on the bid process, but the regulations for the telecommunications program do require bidding, and you should basically bid all jobs where able to, and make sure that as you go through the construction procedures, which will be done in a later presentation, that you go over those. I think I've answered all the questions. So we'll wrap up. I apologize for going over. I know it's important information, and if you feel like any of your questions were not answered well, please reach out to me. Thank you. Okay, sorry, that went terrible. You guys there?